All right, everybody. Good morning, good afternoon if you're here in the Baltics. I have yet again failed to start on at my recommended time of 11 a.m. Riga, but that's all right. We'll power through it. Have a couple charts to show today, and what I want to show is pretty basic, but it goes back to the old stock to flow. I've commented on this over the years, starting even in 2019 in my Powerhouse Twitter account with a massive amount of posts and followers, but you can find commentary on the stock to flow all the way back to then. Those who've been following me long enough know that I posted the old power curve even before Plan B did his stock to flow post, but nonetheless, I think the funny thing about all this is obviously we're all directionally the same. Okay, we all believe that due to the inherent scarcity of Bitcoin, the predictability of the supply of Bitcoin, it's going to outperform any other asset, certainly any other monetary asset in the foreseeable future. The question then becomes, what is the best way to observe what is happening? What is the best way to observe the predictability of the supply, and in conjunction with that, the inherent scarcity of the supply? So in this one, just today, I'm just going to talk about gold. I will reference Plan B's model slightly, but it's just to keep it very, very simple, brass tacks. Let's look at gold, okay? So I'm going to show you a chart here. I've shown this before, as has been with a lot of my charts. This is cumulative ounces mined since 1800, okay? So something like 600 million ounces is presumed to have been mined 200 and some years ago. Now, go till the end here, December 2024, 7 billion. Okay, 7 billion total ounces. I'm not doing any discounting, not doing any fancy things. This is just basically ounces upon ounces upon ounces. And if you go to my website, you can see more detail. If you go to porkopolis.io/top money, porkopolis.io/top money, you can see more details about how this value curve looks in dollar terms and how that compares to Bitcoin. Remember, I do discount this about 15%, which that data really isn't great until perhaps the 70s. But there are a variety of sources. Nick Laird is an Australian researcher that has a lot of this data. I've cross-referenced it, World Gold Council, CPM Group, Silver Institute. Nonetheless, it's actually picked up a little bit, the clip of this growth in the last 50 years. But if you just measured the growth of this in a compound fashion, we would find that it is indeed exponential. I got to put silver on and then I'll take it off. We would find that it's exponential, and that means that the growth is a straight line on log scale. Interestingly, according to the data, that sort of exponential growth came later. As I said, it picked up later. But you can see this is a straight line on log scale, going from something like 1 billion 100 years ago, 1 billion ounces, to 7 billion today. And if you wrapped all that up into what a compound growth formula would give you, it's about 1.8% per year compounded. It actually is falling. It's closer to about 1.7 now even. Again, it's not, you're not going to find rock hard statistics one way or the other. We can call it 1.7% per year, 1.8% per year compounded. That's what it is. That's what it grows at. Now, what is the stock to flow? That is sort of the simple economist's way to look at this. It's just you take 1 divided by this percentage, okay? I much prefer percentages because percentages show you growth rates. They're exponential. Compound growth is the main thing about how finance works. As far as stocks and flows go, most everything grows in exponential or a straight line on log scale. So I like looking at compound growth rates, looking at percentages, right? So like I told you, 1.7, let's call it 1.7% per year. All right. And if you take 1 divided by that number, you will get a number that is somewhere around 60. 60. So 60 is the stock to flow of gold. And it simply means that new production that came on this year, all right, it's 1.7%, the entire total history of gold, because remember, gold doesn't tarnish. Gold is a good store of value. It's durable, it's reliable, it's divisible, it has value in and of itself, all the things that Aristotle talked about. So it's a good store of value. 1.7% per year, or a stock to flow of 60. So the 60 just tells us that it would take, at the current production rate, 60 more years for the stock of gold to double. Now that is actually slightly off even, because you really just need to look at doubling time. And doubling time is actually, this is where, again, I don't see much value in stock to flow in principle, because again, taking 1 divided by 1.7% will give you something like 60, but that is not actually going to take you the full amount of years to double the stock. For that, you need to use log of base 2. And so if you just run that over 1.7%, you're going to get 42 years. So think about that. There's even confusion right off the bat. Is it 60? Is it 42? If you measure the compound annual growth rate of this gold supply from the year 1800 to now, if you do now, like I said, it's going to be a little bit faster, 1.8%. Doesn't matter. Pick 1.7, pick 1.8%. The doubling time is closer to something like 42 years. Whereas the stock to flow, which is this just simple, like economists' way to do it, will give you 60. So what's correct right off the bat? 42 years or 60 years? That's criticism number 1 with stock to flow. Okay. Now, let's apply it to price. Here's the gold price as it has floated freely. And it certainly has been flying high in value as of late. All right, this is log scale again. But since it's basically been floating, it was depegged from the dollar after the Nixon shock in August of 1971. We saw it shoot up to $800 an ounce for a couple seconds on the COMEX, then fall back down, 20-year bear. 2000 was a great time to buy. $200, $300 gold price per ounce. Now, $2,700 an ounce. Okay, so if we want to make the contention here, this is the whole thing. If we want to make the contention that stock to flow has some value for how Bitcoin can be, stock to flow has some utility to show us how Bitcoin can be valued, well then it sure as heck might help us if we can see how it works for an age-old asset such as gold. All right, so let's see that now. Let's run some compound growth rates on this percentage since 1971, on this percentage growth since 1971, and see what we get. Okay. First thing, as always, most financial markets, not Bitcoin, but most financial markets are exponential. So that means a straight line on log scale. Okay. I didn't do it here. This is the actual ounces. I didn't do it. But again, over the really, really long term, this stuff just evens out. So like I said, it's closer, maybe 1.8% over 200 years. 1.7% over 200 years, 1.7% over 200 years. But if you look over in only like the last 50 or 100 years, something like 1.8%, okay, per year. All right. But now we're just going to do it over the price. Because again, the intention is to look at stock to flow as far as ounces out of the ground, and then what we could maybe infer of scarcity of gold and the value of gold from that. What's the slope of this curve? And I don't mean the actual statistical slope. We have slope and intercept. It's a little bit different. Okay, so the intercept here is at time 0 is 41. All right. Sorry, that's the price. 132. See the black line, 132, the regression. So see that our intercept is actually higher than the price at the time. So we need a lot more data to really get that curve to help us. And even here, it's not a great R squared, 78%. But nonetheless, we can tell that for sure the growth of gold is exponential, because if we did other curves, and I've shown this in other videos, you'd get a lower R squared than 78%. It would be worse. Okay, so gold is an exponential asset. Just like most financial assets in the world, it has an exponential trajectory. What is the slope of this curve? That's what I want to answer today. Okay? And the way I'm going to do it, first of all, is I'm going to show an evolving exponential trend line. And remember, I did this with Bitcoin at the start of the year. It's just a way to kind of see how this black line has evolved over time. And it helps us to see how good of a fit the entire black line is itself for, for gold. Okay? So I'm going to put the evolving exponential trend line in a dotted black line here now. Okay? As we get closer to today, this play button, this dotted black line, will get closer to the all-time line, okay, which is denoted by the 100. All right, so we're getting better. We look pretty good here from already 10 years ago, but still below, converging on that all-time line. And this just is always going to be the case, right? It's nothing is perfect. We need more data to sort of build more trust in the probabilities. And this is just how gold has looked over the last 55 years. So it grew very, very fast. Look at the play button. It's right on price back in the 70s. Okay, you see that the all-time curve at the time is like $130, $140, all the way back to the intercept, $132 per ounce. The all-time exponential regression was way steeper at the time. If we drew an all-time curve, it would be like this, way up, not flat like the all-time, it'd be way steep. All right, gold was screaming up here. All of a sudden, many economists thought gold was going to go to zero after it depegged. Shows you how much economists know. The price is, just on a very strong upward trajectory for the first 10 years of being depegged. So the all-time trend is like pretty high, well over, the evolving trend is pretty high, way over the all-time trend. And it settles down here. Again, the dotted black line is sort of as time is moving by. It's just it's the last point of the trend line. It's not exactly the tangent, but you can just imagine that the intercept's going to be lower, and this sort of slope value, or the last value before projecting out, is going to be higher. All right, so that's what you see in this dotted line, okay? But as the price falls down and down in this sort of sideways bear market for 20 years, we settle down into something like a slope that is more like what we've seen in the last few years, and indeed all time. Okay, so that's how it works. All right, and then as we go into the future, these things are the same, exactly the same. No difference at all. So there's your evolving exponential trend line into your all-time exponential trend line. The same thing, but it just shows you, a little bit of the difference here. But now, we want to get back to this stock to flow idea. How do we do that? Well, first we got to find the compound annual growth rate. Okay, doesn't make sense to do it any other way. You got to find the all-time compound annual growth rate that gold moves in. Okay, so I'm going to zoom in because it's going to get a little bit more confusing. I'm going to zoom into present times, and I'm going to put that number here. All right, so this red line now is a percentage. See it on the right side. It's a percentage. This is the compound annual growth rate of gold. Okay, this is just a simple future value, present value formula, present value, future value formula, where our present value, I'm using this evolving trend line, okay, just to see the growth. But the present value of the evolving trend line is not here. It's not $133 per ounce. It's 41. All right, it's $41 per ounce. 43 actually, I guess it is, because that was the intercept. It's 43. Sorry. The price was 41. The intercept of the evolving trend line started at 43. And then we just grow it out. So now we can even take off the price. I'm doing a compound growth, to get us a sort of blended, overarching, weighted type of a growth of the gold price. Let's just take the price at any given time, which is the evolving regression line. So it's take even the straight line out. Take this $620. All right, that's our future value in 1992. Let's look back to 1971 August. Our present value is 43. Let's run some compound growth. So if I go back wherever I was in 1992, at that time, the evolving trend was 13.9%. It was actually worse for the price if you had that, because look at the price. Price was under trend at that time. Price was only, $350 in 1990 and going down into Brown's bottom. Remember, this is Gordon Brown, sold all the UK's gold at this point. Literally at the bottom of the market. Hilarious what our leaders can do for us. So 1992, just for an example, the compound growth I'm showing is the evolving trend divided by that $43 an ounce, which is where the trend started. So it's not the price. If I did the price, $354 is the future value, it would be even lower, even less. But nonetheless, this is the best way to do it. It's the most simple way I can sort of show you. So let's just grow it out. Let's grow it out as gold is growing more here. We start this boom again in the 2000s before the GFC. Then it goes sideways again, basically for another 10 years, 8 years, while Peter Schiff was telling you not to buy Bitcoin all through here. And then we go up till today. Great year for gold last year. I cut it off in June, but whatever. It's moving up to $2,700 an ounce. Okay. Now let's do the evolving stock to flow. How did stock to flow look over time? Well, before I go to stock to flow, let me just say, what can we analyze here? Basically, we're talking about trends. We're talking about long-term valuation models. Okay. So clearly, while gold was shooting up here from being artificially pegged for its entire history by governments, which is literally what happened. I mean, governments had been pegging their currencies to the price of gold literally for millennia before this point. Which is interesting, right, to think about that. And economists thought it was going to go to zero. Of course, the market didn't do that. The market wanted to buy more and more gold at this point. So we had really high compound growth values here. Okay, so look at that. There's 60% compound growth per year. I mean, that's just massive, right? That's doubling every year and a half, right? Quicker than a year and a half. Okay, rule of 72, very quick, very easy. Take 72 divided by this 60%, that's your doubling time. And doubling time is way more valuable than stock to flow, just so you know, because it's compounded, it's stronger. It's not just taking this percentage and dividing it, 1 divided by the percentage. That's the stock to flow. It's you gotta go to the log of base 2 to get to it. But anyway, we see that the 70s was pretty wild. Once we settled into this regular growth rate, which again took a long time to settle into till today, we see that this line starts to flatten out. What does it flatten out to? Something like 7%. Okay. Something like 7%. So let's do an evolving stock to flow. Evolving stock to flow. What is it? Stock to flow, again, it's just 1 divided by the compound growth over time. So I'm just taking 1 divided by the compound growth over time. Here you get the stock to flow. Larger is better for a stock to flow number. Okay, this is the yellow line now. So it's just, I have them both on the right axis where it says compound annual growth rate or stock to flow. Nonetheless, you see the number's like 13, 14 today. And of course, it was more volatile, even lower, which meant quicker increase in price earlier. Okay, but basically over time, we can see that the stock to flow is something like 13x over time. 13, let's call it 14x. 14x, that's simply 1 divided by the compound annual growth rate you see, which is 7.3, 7.4% per year compounded. Well, keeping this idea of stock to flow and valuation in mind, something should come up very quickly and clearly for us here. 14x is nowhere near the all-time gold stock to flow of 60x. So how to make sense of it? If this gold comes out of the ground at a rate of 1.8% per year, all right, doubling time of 42 years, but just take a simple 1 divided by this rate gives you a stock to flow of 60. If the stock to flow is 60, but the price does 13, what are we supposed to make of that? Are we supposed to make a more complicated model now and take the price stock to flow divided by the actual ounces out of the ground stock to flow? I'm not sure. Excuse me. I'm not sure. I don't think it's helpful at all, basically. I don't see what stock to flow got us here as far as understanding the inherent value of the gold price. Gold price runs at 7.4% per year. If you look back since it started to trade and float freely in the market, somewhat freely. Stock to flow is 14x on the price. That's, something like 4 times different, 4 times smaller than the stock to flow of the actual ounces coming out of the ground. What is one to make of that? I don't know. And we can project it out, all right? It's going to get a bit more confusing here, but let's take off the evolving now. Okay, the evolving. Let's just look at the all-time now. All-time exponential growth of the gold price. All right, it's on this curve. Let's evolve it out into the future. Let's look at this compound annual growth rate. It's a little bit of a hiccup here. I couldn't make this any smoother because basically what I'm doing here is I'm taking the evolving trend, right? But my present value is always way low. The figure, it affects here. My present value is 43. All right, 43. But as we move out, remember, what does compound annual growth mean? It means a straight line on log scale. It means a constant growth rate. So to get to that strong constant growth rate of 5.1% for the gold price, the future value now is the exponential regression at 100, the all-time curve, right? The R-squared of 78, it's 132. So that gives us a lower compound growth into the future. I know there's a lot of arrows on here, but the point is, let's take the evolving out even. As you look here from the present into the future of the gold price, you get that fixed. See that fixed 5.1%? We're done evolving. I know it should seem more beautiful. Like it's hard to get that. It doesn't work that way with the math. Like here, as I grow out on this curve, our future value has to be 132. It can't be 41. But as I grow out, as I do this evolving part before present day, the future is something like 41. It's actually 43. It's the evolving. Anyway, there's a lot of number crunching there just to see you, but just to show you. But you can see the point. All right. It's something like if you really caught the peaks and the troughs, right? So if you held really from the start to finish, all right, $2,600 gold ounce at the end of last year. You picked it up at $41 in August 1971. Then you would get 7.3% compounded growth. But this is a smoother number out into the future. How do you get the smoother number? You take it on the solid black line. The solid black line. So the present value is actually much higher. It's 3 times higher, $132 an ounce. It's just how you have to do it. So you get that kink, that kind of ugly looking kink. Normally I don't like my charts to look ugly like that, but that's just how it is. So this is the all-time compound growth of gold, 5.1% into the future, and our present value here is, of course, 132. Okay, future value is whatever it is on the curve at any given point. Now let's go out even to the end of 2039. All right, start of the 2040s. What's the projected gold price? First of all, $3,900, $3,900 an ounce. That's like a third more than, I guess half more than what it is today. Close to half, close to 50% more of the actual price today. Oops. So first of all, it's not that exciting. Second of all, it's just, this is how compound growth curves work. So again, what is one to do? If we want to talk about stock to flow and analyzing it and critiquing it, what is one to do with this information that really the all-time compound annual growth rate, let's put the evolving stock to flow now. Again, it jumps. I know it's not pretty there, but this is just the all-time curve, okay? We're at 20x now. 20x on the stock to flow price curve. Okay, this is the exponential growth of the Bitcoin price curve, 20x. What is one to do with the actual mining production stock to flow, which is 60x? It's 3 times different. Are we supposed to take that 3x multiple and build another model? It gets too complicated in that point. And you can already see right here, by the way, that it's complicated because, you know, everybody's got different returns, right? You could, if you came in here at Brown's bottom, you bought when Brown was selling, you'd have a much greater return than 7.3% or probably even, or certainly 5.3% per year. Let's take off the S2F. If you bought here, all right, clearly at $263 an ounce, when the trend was 573, now that you're at 260, you're way over 7.3% per year compounded. So, of course, this is all scientific. It's blended. It's weighted. It's you know, we're talking about the mean. But whether it's 7.3% per year or 5.1% per year compounded, or a stock to flow of 14x or 20x, what is one to do with a stock to flow of 60 on the actual ounces coming out of the ground? I don't know. I don't see how that makes any sense. Now, let's go and look at silver really quickly, just before I end this. I'm going to come back. We're going to do a couple videos on this, a couple days. This is just the intro. It's the primer. We're going to bring this back to Bitcoin, but now we're just talking about gold and silver a little bit. Here's silver, all right? The mining ratio of silver used to be something like 15 to 1. See there? In 1900, 100 years ago, something like 15 to 1. This is the rate that Isaac Newton used, around that rate, when he pegged gold to silver in the mint, the British mint. It has actually converged to something like 9 to 1 now. If you took 7 into 61, you'd get something like 9. All right. So again, what's someone to do with that information as far as value goes for silver? Okay. But if you measured the slope of silver's curve, this is the wild thing. Remember what I told you it was, what it was for gold here? 1.8% per year. Ounces coming out of the ground all the time, 1.8% per year. Silver is lower. It's 1.4% per year compounded. 1.4%, 1.5% per year compounded. So it's more scarce than gold. You can see, indeed, it's shallower. Its growth rate is more scarce. Gold has been coming out of the ground faster than silver over the last 100 years. Is that because people want it more? Sure. But people still want silver for electronics and conduits and jewelry, of course, store value purposes, also in bullion. We'll talk about the differences here in the next video. I don't want to bore you too much with stock to flow today. Just nonetheless, I mean, needless to say, what is someone supposed to do with the information that gold stock to flow is something like 60, and silver's on this chart is actually 70, 75. 75. It's a higher stock to flow than gold. Well, I don't know if he's taken it down. This was, I just did a quick image search. This is from Money Morning. I don't know. They're looking at Plan B's research. This is in July 2019. I know that Plan B put his out somewhere in the spring of 2019, his first effort on a stock to flow model. Again, myself, Giovanni, we put out the power curve research in 2018, just to point that out. But we have this chart here that he put, and I couldn't find his article. He might have taken it down. I don't know, but his model has changed over the years. Again, I don't know how a model can be considered good if you keep having to change it. But here, let's just look at the numbers here. I know this is a little bit harder to see. Let me try to zoom it in for you. There we go. This is from his research, 100 trillion USD. Okay, and this was in 2019, what he was saying. He's got things like platinum, palladium, diamonds. By the way, there is no known price. Show me a price graph of diamonds, please. I've asked that in the prior streams. Someone show me a nice chart with a worldwide diamond market over the years. Okay, not some New York diamond dealer, but a worldwide spot price for diamonds over the last 50 years. Someone show me that. I don't know how he got the stock to flow of 19 here. But anyway, let's look at gold. Gold, he says stock to flow of 54. Okay, it's pretty close. It's actually the all-time number is a little bit better than that. It's about 60, so he's wrong there. He's changed it over the years, but nonetheless, he's 54. Look at where he puts silver, 3. Remember what I just told you? I'm going to have to, this is going to be zoomed. Oh, good, it's not zoomed out. If you look at the silver and the gold curves here, gold is running at 60. Silver's running even higher at 75, okay? So he puts it at 3. Why did he do that? What he was doing was he was removing all of the industrial stock of silver, so removing that stock, but keeping the full flow. But that doesn't actually make any sense. Okay, I'll talk more about that tomorrow. You at least have to keep some store of value portion of the stock to flow if you want to run this sort of full number, right? And in this case, by the way, if you want to use 3, it's not incorrect if you want to take the full flow. Okay, this is the full ounces of silver that come out each year, but have a very compressed stock where you take out all industrial silver. That's fine. But if you do that, you can't show 54 for gold. You got to take out non-industrial gold and only look at the monetary stock of gold. And if you do that, full flow of gold versus a monetary stock, I'll show this tomorrow. I'm not going to do it today, but I'll show it tomorrow. You get something like 20 for gold. So it'd be like 3 versus 20. So already it's apples and oranges, not consistent. Diamonds should not be here. It's not even a normal market. Diamonds is a scam market. I mean, again, we do it for the lovely women in our life, but there's no spot market of diamonds around the world, and it's a tightly controlled market. So I very much disagree with these numbers as they are here. But again, he's showing the Bitcoin stock to flow. Okay, it increases. It's becoming more scarce over time. But hopefully you can already see just with this chart that I've shown, the sort of the long history of gold and silver, and even the longish history of, it's now 5 years, 6 years of using stock to flow versus using the power curve. The inputs are very shaky on stock to flow. I hope that is visible here. Very, very shaky inputs. And if you actually look at price, it's way different anyway. Price is the thing that we're trying to model, right? We're trying to model the value of gold. So the stock to flow all time on a trend line is 20. If you did an evolving exponential, and again, the start date is way over the trend there. It's down to 43. So it jumps, which, again, not a great way to look at it in my view. It's 14. Whether you say 14, 20 as a stock to flow, whatever. It's not nearly what gold is doing here. It's doing 60. So how to square those numbers? They don't make any sense to me. I will show more of this tomorrow, and perhaps in the video after that. I've done various critiques of stock to flow over the years. Let's just do it piece by piece, step by step. I think it's really important and interesting to just look at one asset. Then we can look at Bitcoin. We can compare. We can talk about Bitcoin stock to flow tomorrow. I just want to look at gold today. And the stock to flow of the price is 3 times different the stock to flow of the actual ounces out of the ground. Here it's 60. Here it's 20. Going forward on an all-time basis. Any questions? Let me know, guys. Again, just if you're curious about this gap, why it happened here. I know it's not so beautiful. I like to try to give smooth, comprehensive charts, but the straight line, always straight. See, the 5.1% doesn't change, 5.1%. That's just the slope of this black line all the way. And your present value needs to be this higher number, 132. But if you want to get something evolving to show you how it changed over time, you can't use the 132. You have to use the 41. The 41. Because the 41 was actually, or 43. 43, it's the evolving number. The actual trend line of gold, the actual price of gold was down here. It wasn't up at 132 at the time. So that's how you calculate the red line, and then you smooth into these all-time growth numbers. But this is actually interesting in itself. I used to say this a lot, that gold was a 7.3% compounder, CAGR since the 1970s. That was the number that was always in my head, just 7%, 7.5%, doesn't really matter. That's what gold did. That's a very specific catching of the gold price, okay? That's catching gold at today's price, whatever it is, which is over trend, and catching it here well under trend at $41, $43 an ounce. The trend, the all-time trend is up here. And it's probably more balanced, just safer, more reasonable when you're talking about all-time numbers to forget anything that was like buying gold in between 30 and $60 an ounce. No, I mean, over an all-time sort of figure, if you want to get that sort of blended, weighted CAGR, you got to start this present value at 132 $132 an ounce. So that's why you have this jump here. I haven't quite figured out a smooth way to make that work, but it doesn't work, basically. Actually, I think I just figured out a way. I could probably, well, I don't know. I have to think about that more. Nonetheless, doesn't really matter. The all-time is here. It's 5.1%, 5.1%, the slope of this black line. So 5.1%, that's doubling. That's doubling every 14 years. Every 14 years. Okay. So again, doubling times are much better. If you look at doubling time of price will double every 14 years. Roughly. Again, 78% R squared. It's not so great, but that's what price does. When it comes to gold, and if you look at, again, the doubling time of this, it's 42 years. 42 years is the doubling of a 1.7% CAGR compounding of the gold stock, not 60. So again, many different numbers to look at, but I do not agree with just putting these numbers here and then putting Bitcoin and saying, okay, now we're going to get to Bitcoin's valuation from these numbers, because it doesn't work for gold. This is the point of what I'm trying to tell you. It just does not work. Here we have a stock to flow of 20. Here we have a stock to flow of 60. All right. I've beat a dead horse. that's all I wanted to show today. This little stock to flow dynamics of gold. Hope you guys like that. Let me know what you think in the comments. Happy to do different charts that you want anytime. Just let me know. Thanks, Gio. Appreciate it.